Now we move to accounting for leases. Okay. Under ASB number 16 or IFRS number 16, it says that the firm need to adopt a single lessee accounting model for all leases within a term of more than 12 months. So we are going to use the same accounting model for all leases. It requires that the lessee is the company or party that pay sum of money to the lessor and given the right to use the assets. Okay, requires the lessee to recognize an asset and also a liability for their leases. Okay, if you sign a contract with Mercedes to lease their car, so once you sign the contract, you're going to put in your balance sheet, also known as statement of financial position, okay, the amount, we call it as the right to use the assets, the right to use the assets. And also you're going to put in your liability, the liability, your liability associated with the lease. So rules from ASB number 16 relate to initial recognition as usual, measurement, and disclosure of assets and liability. For the initial recognition, the lessee at the commencement date of the lease must recognize a right of use asset. This is asset. This is asset. Right of use. This is your asset and also your liability. Liability is your commitment. How much you're going to pay the lessor. So these are the two things that you must recognize when you start signing, when you sign the contract with the lessor. Okay, what is lease liability? The liability is to be measured at the present value of the lease payment that are not paid at the commencement date of the lease. The present value is calculated based on the interest rate implicit in the lease or lessee's incremental borrowing rate. What does it mean by present value? For example, this is the term of your lease. 1, 2, 3, this is 5. 0, 1, 2, 3, 4. Okay. So every year you're going to pay maybe 50,000 to use the machine. 50,000, 50,000, 50,000. So this is your commitment, 50,000. So how much is your liability? It's not 200,000. Yeah, I think the simple arithmetic will be your liability is 200,000. But it doesn't work like that. You need to calculate your present value from this future liability. So you're going to discount this. You can use your PVIF or PVIFA table and then come up with the value. The value is not 200,000, it's less than 200,000. So this value will be recognized as your liability. For example, you need to use your interest rate, maybe 5%, for example, 5% interest rate. This is the implicit interest rate. So we're going to discount your future liability using the present value technique. So that will be your liability. Okay. So lease liability includes fixed payment. Can be a fixed payment. For example, I give you 50,000, or variable lease payment. We have this variable lease payment. Okay. Exercise price of a purchase option. If you want to buy the assets later on, what is the price? Payment of penalty for terminating the lease. If you terminate the lease, you might need to pay certain penalty. And residual value guaranteed. This is residual value guaranteed mean the guaranteed value of that asset. The guaranteed value of the asset, the identified assets. Okay. So for the assets, we have this right of use. Right of use. This is the initial measurement of the right of use asset is very similar to the initial measurement of PPE. Okay, we are going to measure the right of use at cost, and it include any purchase price, the purchase price. Okay, this is number one. Number two, directly attributable cost. And number three is initial estimated of cost, dismantling or removing the cost. This is similar with AASB number 16. Sorry, number 116. Yeah, there is accounting for property, plant, and equipment. So this is fall under assets. This is your assets. Okay. After the initial measurement, sometimes we need to come up with a different measurement. And the PPE, we have two methods. I believe every one of you still remember. The first one is what we call as the cost method. The second one is revaluation method. Okay. So after initial recognition of the right of use asset is subject to depreciation. So we have depreciation every year for our right to use asset. Okay. And the lease should recognize interest on the lease liability. For the liability, every year we're going to add the interest. So we're going to end up with 200,000 if we have 200,000 later on. And we're going to classify the cash repayment of the lease liability into the principal and the interest portion. So this is about liability. This is lease liability. If you make payment of 50,000, how much? Maybe I can just put a number here. 8,000 is your interest expense. Interest expense, for example. 42,000 is the principal payment. This is the component that will reduce your loan. So you need to distinguish this because this one will go to your income statement. Okay. So, but for asset, it's very straightforward. You're going to provide depreciation, annual depreciation for lease. For lease liability over the lease term, para 36 of ASB number 16 requires the payment to be divided into interest expense incurred and also reduction in the lease liability. So this is what I mentioned before. For the right of use, after the initial recognition, the right of use asset are depreciated. For example, the asset can be used for 4 years. So if you have 4 years, maybe you can use straight line method. If you use straight line method, so you're going to divide by 4 years. So depreciation recognized is similar with AASB number 116, that is property, plant, and equipment, whereby depreciable assets are those whose future benefit are expected to expire over the time or by use. So they don't clearly mention what are the methods that we should select to come up with the depreciation amount. So it's up to you. Next is accounting for executory cost. This cost may be for the repairs, for the insurance. The accounting standard does not provide detail how we should treat this payment for non-lease component, but normally it will go straight to the income statement. For example, additional service provided by the lessor, the cost of such item is effectively borne by the lessee, and the payment should go as expense or prepayment. If your payment is, you make the payment before the accounting year start, so or at the early of the accounting year, it should be recognized as prepaid. And later on, slowly you're going to transfer for the lessee. It's going to be recorded as prepaid, and from time to time you're going to move the prepaid expense to your real expense, to the expense accounts. Okay, this is a good example. It's a very long example about accounting for leases. Okay, let us take our time slowly to read these questions. Okay, this question, this example from Loftus textbook, example 10.4. On 30th June 2022, Face Limited leased a vehicles to Book Limited. So Face Limited is the lessor. Yeah, this is the lessor. And this is the lessee. Okay. Had purchased the vehicle on that day for its fair value of 89,221. So this is the fair value of the assets, fair value of the identified asset or underlying asset. This is the fair value. The lease agreement, which cost Face Limited 1457 to have drawn up. So the cost of the lease agreement is 1457. Okay, 1457. So this is the lease agreement cost. The lease agreement cost. Okay. Lease term is 4 years. You're going to pay, Book Limited will pay for 4 years. Every year, payable in advance on 30th June each year. So you have to pay before you use the asset. So before the year start, you're going to pay. So next year, you're going to pay, for example, for year 2022, you're going to pay in 2021. Yeah, 1 year before that. Yeah, before the accounting year start. And the amount is 23,900. That is annual payment. So you're going to make 4 equal payment, 23,900, 23,900, 23,900, and 23,900. The asset has economic useful life of 6 years. This is what I mean by depreciation. To calculate depreciation, you have to determine the economic life of the assets. Okay, and we have the estimated residual value at the end of the term. So the residual value is 15,000, and from this 15,000, 7,500 is guaranteed. This is guaranteed by the lessor, yeah. And the balance is 7,500. This is ungranted, UG, ungranted. No guaranteed in that estimation, yeah, estimation. Included in the annual payment is 1,900 to cover reimbursement of the cost of insurance. If you look here, we have 23,900 payment, but 1,900 is for insurance. So for the asset, for the identifiable asset, the payment is only 22,000. So this is the payment for the lease. 1,900 is for insurance. This is a prepaid insurance, yeah. So what will be the journal entries recorded by Book Limited to recognize the lease and the related payment throughout the lease? So I'm going to show you for all the 4 years how you're going to account for accounting for lease. Yeah, maybe you're looking at the lessee perspective. Okay. Okay, the solution state that at the start of the lease, the lessee should recognize the lease liability based on the present value of the lease payment not made on or before the start of the date, since the question told us that we have to make payment in advance. So all the 4 payment will be considered as the present value of the liability. The discount rate to calculate the present value of liability is the interest rate in this lease. That is the rate of discount, the lease payment, and unguaranteed residual to the aggregate of the asset fair value and any initial direct cost. The initial direct cost is this one, IDC. This is IDC. Initial direct cost. I call it IDC, yeah. Initial direct cost. 1457. 1457. Okay. So as the lease payment in this example consists of fixed lease payment and the residual value guarantee, the discount rate is the rate of discount the annual fixed lease payment net executory cost 22,000. This is net lease payment 22,000. Come from 23,900 minus 1,900. So this is the net. The net is 22,000. The residual guaranteed value is 7,500. You have another 7,500. And the unguaranteed residual is 7,950. We have another 7,900. Sorry, 7,500 to 91178. So the total will be 91178, which is the sum of the fair value of the assets of 89721. This is the fair value of the asset 89721 plus the IDC. IDC is 1457. So it should be come to 91178. Okay, so in simple way, you have here 22,000, all this payment, okay, and then you need to discount this, and the present value here should be 91178. So what is the discount rate? So you need to do the calculation from there. If you learn during your business math, you can reverse do it the other way around, and it'll give you the implicit interest rate. So in this question, it gives you that the implicit interest rate is 7%. Yeah, 7%. So in your exam later on, I'll give you the implicit interest rate. So you don't have to work, come up with the calculation of the interest rate. Okay. So let me show you how to calculate the present value of lease payment. Yeah. So how much you're going to pay? So now when you start the lease, this is here, you're going to pay 22,000, and then you're going to pay 22,000, 22,000, 22,000. So this is beforehand, a day before the lease. So we don't need to discount this. We don't need to discount this. This is your on the date here. You pay 22,000. So you only need to discount the balance repayment. So I'm using PVIFA 7% and for 3 years. Yeah. So that's why 22,000 plus 22,000 multiplied by PVIFA. If you have the table, you have 7%, 3 years. This gives you 2.6243. In your exam later on, I'll give you the PVIFA table. Plus the guaranteed amount. This is the guaranteed amount plus 7,500. So this times this is 7,500. Another one here, 7,500. So this value is the guaranteed amount. So this is multiplied by PVIF 7%, 3 years. PVIF 7%, 3 years. So the payment here, the present value of lease payment will be 85,457. This is excluding the unguaranteed. If you want to calculate the unguaranteed, the unguaranteed residual, the UG, it will give you another 7,500 multiplied by PVIF 7%. That is 4 years. 4 years means after the completion. Yeah, sorry, after the completions. So that is 4 years. So this gives you 5,722. 5,722. So the total present value will be 91178, which is equal to the fair value of the asset plus IDC. This is IDC. Yeah, IDC. So 91178. So you must know these calculations because it will help you to come up with the table. Okay. Let us move to the table. So if you look at this table, how much is your present value of your lease? Yeah, present value of lease payment. Lease payment. This is your present value of lease payment, 85,457. 85,457. That is your present value of lease payment. Okay. So when we want to come up with these lease payment schedules, okay, we normally start with this 85,457. 85,457. Okay. When we start, this is 85,457. Okay. When you sign the contract of the lease, you start paying 22,000. 22,000. So your liability is not 85,000 because you paid 22,000. Okay. When you sign the contract, you paid 22,000. So that's why we have your liability is 63,457. This is your liability, this liability that you should report in your accounts. Okay, 63,457 because this 22,000 paid in advance. The question paid in advance. Okay. So on 30th June 2023, you make payment of 22,000. So the standard says that we need to distinguish between the interest component and reduction of liability component. So how to determine the interest component? The interest component is equal to 7% multiplied by 63,457. So this will be the interest component. You'll get 4,441 something something. Or if you round up to the nearest dollar, it gives you 4,442. So this is the interest. The interest which will go to your income statement. Interest expense. This is your interest expense. So from 22,000, 4,442 is the interest component. So the balance, is 22,000 minus 4,442. The 17,000 is the principal, the payment of principal. So this amount will reduce your liability. This is the liability. In your lease payment, lease liability, if previously you have account 63457, you're going to debit this by 17558. 17558. So your balance CD for the first year will be 45899. So this amount will be reported in your balance sheet, statement of financial positions. So this gives you a balance of 45899. So that is for the first year. For the second year, you're still going to make payment. You're going to make payment of 22,000, whereby you need to identify how much is your interest. Your interest will reduce because your principal, your loan already reduced. So your interest for the second year will be 7% multiplied by 45899. So this gives you a value of 3213. 3213. So this is the value of interest expense for the second year. And the difference, 18787 will be the repayment of principal. It will reduce your principal. So 45,000 minus 18787, this gives you 27112. And it continues until the end, whereby at that point of time, your balance will be 7010. This will be the last one. The last one, 7010. You make payment for 123, yeah, 123, and then before that you have a payment of 22,000 for payment of that, and finally you're going to make payment for the residual value, the guaranteed residual value, 7,500. So this is 7,500. The interest component is 490, and the balance 7010 will be deducted from your balance of liability. So your liability will be zero after 4 years of using the asset. So this is the liability account. So you must be very familiar how you're going to do that, how you're going to record this. Okay. So I'm going to continue with the journal entry. So for the first year, before when we sign the contract, we're going to record that one as our assets. Yeah, our assets. We call it as right of use of vehicles. Right of use of vehicles. This is your assets. Okay, debit 85457. 85457. This is the fair value of the assets. This is the fair value of the assets here. Sorry. 85457 based on the present value. Okay. 85457. And then we're going to also incur here the executory cost of 1,900. 1,900. We make payment 23,900. So this is the payment 23,900. It includes 1,900 for the insurance. So we're going to debit here the prepaid executory cost 1,900. Yeah. So the net amount here will be 22,000. Yeah, the net here. The net payment for the liability is only 22,000. This is more on expenses, yeah. But since we are not using this yet, so we record it as prepaid. Prepaid executory cost or prepaid insurance for next year. And the balance will be your lease payment liability, yeah. Lease payment liability. So executory costs were recognized as prepayment. Why? Because the insurance and maintenance benefit will not be received until the next reporting period. Next year, you're going to receive the benefit. So for the time being, we record it as prepaid executory costs. So this is the process or the journal entries when we sign the contract to lease this asset. This is for the year 30th June 2022. Okay. For the 30th June 2023, we are going to do some adjustment over there. We're going to close the prepaid executory cost here. This is what we paid before this. So since we already enjoyed the benefit of the insurance and maintenance, so I'm going to debit this one, executory cost. This is your expense. And I'm going to reduce your prepaid executory cost. This is your assets. I'm reducing the asset, increasing the cost by 1,900. Okay. Then that is the first one. The second, I'm going to record the payment of 23,900. So this is money out, cash reduced by 23,900. 1,900 will be recorded as prepaid executory cost. This is your prepaid executory cost for next year, 1,900. The interest component is 4442, and I'm going to reduce my lease liability. This is liability, yeah. Liability reduce. Interest expense increase. Asset, this is asset. increase. This is also asset reduce. This is your reduce in liability by 17558. 17558. Okay. And then for the assets, we need to provide annual depreciations. Annual depreciation. So we have this depreciation for the asset 85457. This is the value of the assets. We minus our residual value 7,500 and then divide by 4. Divide by 4. So you have annual depreciation of 19,489. So this is the depreciation cost for the assets. So the depreciation, the general entries will be debit depreciation expense, credit accumulated depreciation. And this continue for the second, third, and fourth year. So the same thing, the same transaction here, yeah, with different amount. You can see different amount. This is from your table. It's good to come up with the table. Okay, no change in your depreciation expense. 3213, 3213 is here. 3213. 3213, 18787. 18787, 3213. 3213. Okay, and it continues with a different, with lower interest rate and a greater portion of repayment of liability. And finally, in the last year, we're going to pay for the 7,500. I'm going to debit here 7010, mean this is the settlement of your liability. Your interest expense is 490, and I'm going to credit here right of use of asset 750. Depreciation amount will be same 19490, and now we offset since in the end of the year one, year one, so the end of the useful life. So we're going to offset our accumulated depreciation with the right of use of asset. So 177,957, 77957, and then we have here another one, right of use of asset 77,500. So if you total up this one, these two, okay, you will close the asset account. Before this, we have, you still remember right right of use asset. Sorry. Okay, we have this one, if I'm not mistaken, 457. Okay, and finally we are going to offset close our accumulated depreciation by 77957, and then another one is from our return on asset 7,500. So the balance will be 0. The balance will be 0. So this is the final process. The final payment is the return of the asset and its guaranteed residual value. If the asset is being purchased, if you buy the asset, the entry will record cash payment. Another entry will then be required to reclassify the undepreciated balance of the asset from a right to use of asset to an own asset. For example, if you lease, join the lease scheme from the automobile company, you can see sometime after 4 years, can return the car to the company, or instead of returning the car, you can make a sum of payment, and that car will be transferred to your name. So this is what I say. You can have that procedure whereby you record a cash payment, and then you need to recognize that is as your assets, your new assets.